What's up, everybody? Welcome to the Stocks channel. In tonight's episode, I'm bringing you another stock market technical analysis update. But before we get into the charts, you know what you gotta do. Go ahead and smash that like button and subscribe to the channel to follow along on all of my updates. Now, first up, we're gonna take a look at the ticker symbol SPY, which is the SP500 ETF. So let's go ahead and crack open these charts and see what's going on in the stock market today. Alright, so if you've been following along on this channel, you know we've been calling for a price target of $341 on the ETF SPY. And we have met that price target as of today's close, closing up closer to around $343, so exceeding our price target by a couple of bucks roughly. So the one thing to note if we look at a 1 hour chart is we did open up yet another gap where there's been no price discovery below us, and that is going to be another support level for the bulls in any event that we have a pullback. So looking at the 1 hour chart, we now see we have these three gaps shown here by these green rectangles. And those areas are going to be strong areas of support in any event that we get a correction and a pullback in the market. So you can see on the 1 hour chart, the price action is still taking the stairs up, and we're still watching the price continue to grind higher day after day. Now that we've met our price target of $341, you can see here we do have the next price target at around $353. Now keep in mind, when we get to these levels, it gets into the area of a potential short squeeze where we could see the price continue to be irrational and parabolic until we see this correction. But now that we have hit our price target, this completes possibly wave 5 of our Elliott wave 5 waves, and we could see a correction any day now. So there are some warning signs that we need to pay attention to in this market. But if we're strictly looking at price action and we're strictly looking at technicals, we see that there's still extremely bullish trends in this market, and there's no reason to panic. We just need to respect the fact that there may be warning signals that we need to start looking at, and we can start incorporating how those warning signals can play into our trading and our planning for the next buying opportunity. So with today's close, we see the price action is still well above the 5 EMA, and the 5 EMA is still nicely above the 13 EMA, and we're still trading in a very bullish uptrend. Now, we did open a gap and met our price target at the same day, and that could potentially leave us for a situation like we had here in early June, where we had this very bullish squeeze into this higher price target, and ultimately a gap down after the gap up, which left us on this island reversal, and we saw volatility and uncertainty enter the market for weeks to come. So in any event that we get a gap down after today's gap up, we would have to look at another potential island reversal, but we'll play it day by day for now, and we'll watch this gap below us very closely to see how it's going to play into any sort of reversal signs. So the first warning signal is this gap on the 1 hour chart, mostly due to the fact that we've met our upside price target while opening this gap below us, so we want to pay close attention to that gap. Now, we do have gaps below as well, but we have not hit our price target when those gaps were open. So those gaps still come into play as support levels, but this gap could potentially lead to an island reversal if we get a gap down. Now, looking at this trend, it's still very strong, and we're still looking at these price levels above in the 350s if we don't get any sort of reversal signs. Don't try to call a top in the stock market. Just be aware of every opportunity and position yourselves to be profitable. If the market pulls back, you don't want to be all in the market, or you don't want to be buying all in at the highs of this market right yet. Look at the volume. It's very stable and actually decreasing somewhat, which is showing that the trend is just in maintenance mode. There's no big money, aka smart money, loading up positions at these levels. So that means you should not be either. The best way to become a good trader is follow the smart money. Don't be the dumb money that buys in and FOMOs at the top. Be patient, and there's always going to be a better opportunity to size into a position. So from the volume we can see here, the last time we had any major volume spikes were in the middle of June, and it was mostly in a sell-off. Right now, we have not seen a lot of big money buying back into this market just yet. We see the volume was after the March crash, and that's when the big money was loading up, and right now they're going to be selling into this upside price targets. So remember, buy low, sell high. That's what smart money does. There's not a lot of smart money buying at these levels. Therefore, there's going to be more downside risk at these levels as well, because eventually somebody in the smart money category is going to dump their position, and we do not know when. So following the technicals, there's no reason to panic. We're still very bullish, but there is increasing risk and increasing warning signs in this market, and we're going to get into that tonight. So let's jump over to the Nasdaq 100, and we're looking at the QQQ ETF, or the triple Qs, and we see that we also met our price target, which was a price target of $280. Now we do have another price target above at $292, and we're going to keep an eye on that price target. However, the price target that I thought we needed to hit to complete wave 5 has already been satisfied. So again, upside potential to downside risk is not as favorable at these price targets. Now we do see the volume on the Nasdaq 100 also looks very normal, and we don't see any high spikes in volume in the buying direction just yet. This market is still in a low volume maintenance mode, where this trend was set on the high volume buying at the bottom, and now the volume is sort of tapering off into a very normal level as this trend maintains and continues to grind higher. So if you're looking at the Nasdaq 100, it's still very bullish with the price still closing above the 5 EMA. And remember, the most important thing to watch on the Nasdaq 100 is watch the 5 EMA to stay above the 13 EMA in a bull run. As soon as the 5 EMA starts to come down and close below the 13 EMA, we know that the correction is here, and we're going to see some downside price target. So we have our price target met on the SP 500 and our price target met on the Nasdaq 100. Now let's go ahead and take a look at the Dow Jones Industrial, and we're looking at the DIA ETF here. Now if you look at today's price action, it was also very bullish, and we also opened another gap below us on the Dow Jones, which now leaves 4 gaps below us in a very short amount of time. So if you remember me saying on the Dow Jones, I did expect to see this breakout level tested as support and then ultimately bounce and continue our upward trend until we close the gap, and it looks like that's exactly what's going on. So our upside price target on the Dow Jones is to close the gap from the crash in March, and if we zoom out a little bit here, you can see that this red line takes us back to the initial gap down in the crash at the end of February. So that gap has been closed on the SP 500 and the Nasdaq 100, but has yet to be closed on the Dow Jones. So we're actually watching a price target that is a lower high from the all-time high on the Dow Jones, and that's because the Dow Jones is still playing catch up and has not hit its new all-time highs like the SP 500 and the Nasdaq 100. So that actually means there's more upside potential in the Dow Jones right now than there is in the other indices, because it's still coming from behind and coming up to try to form new all-time highs. So it's no surprise to see the Dow Jones doing so well, as there's likely money going to be rotating into industrials to capitalize on the more potential gains that are there in this ETF. So the test of the support was very successful, and we see the Dow Jones grinding higher, but we do need to acknowledge that there's downside risk in this market as well. And this upside price target could also be a signal that the market will be ready to take a cool off after we hit these upside limits. There may be big money that decides to start dumping their position. So we need to keep that option in the back of our minds, and we need to be positioned in a way where if there is a correction or a dip buying opportunity, that we have some capital available on the sidelines to buy in. These are not the price targets, and these are not the levels to be putting all of your money in and all of your chips in the table. There's always going to be a better buying opportunity, and the saying buy low, sell high could not be more applicable than times like these, where you really want to be buying back here in April and May, or if you were able to back after the crash in March, and you want to be sizing out of your position slowly as the stock market goes higher, preparing yourselves to be ready to buy a dip in any event that we see that correction that's going to be coming very soon. So on the Dow Jones, our upside price target is still 289, and above that we do have another price target at 293. So those are the levels you need to be watching on the Dow Jones, and all of the support levels are going to be just below at these gap closures. So let's jump over to the VIX, which is our fear indicator, and here we have another warning signal that we need to pay attention to. So we see that the VIX hit a bottom here at about 21.4, and we see the VIX sort of formed a bottom and a bottom pivot where we saw the price bounce off of this 21.4 level, and now we see the VIX sort of form this pivot and it's starting to head higher. And we can see that because the VIX now closed 4 days in a row above its 5 EMA. Now that might not look very scary, but it is a warning signal that there is fear slowly starting to creep back into this market at these high price targets that we're now trading at. And the VIX is always a great indication of fear entering a market. As we can go back and see here in early June, we saw the VIX form this pivot bottom, and we saw the VIX kind of creep up for 3 or 4 days. And then we had this huge spike in fear where the VIX shot up the next day like an absolute rocket launch. And that's exactly what the VIX does. It shows warning signs in the market before the actual price action catches up to show you what's going on underneath. So if we go back and we look at the S&P 500 in early June, we can sort of see this effect where the prices were sort of starting to show that we were at this high, and we did have this gap up as well around the same exact time. So right here where my crosshair is, you can see is June 5th, which is the same exact time that the VIX started to show that bottom. And we stayed in this island top for about 4 days after that gap up before gapping down and seeing a huge sell-off. And that right here is where the VIX spiked. So we are at this increasing risk phase where the VIX is flashing warning signals, and it's right there in front of our eyes that the VIX is slowly creeping up as the market creeps higher. Now remember, I always say we want to see the VIX go lower as the market goes higher, because that shows us that fear is leaving the market as we reach new all-time highs. We don't want to see fear increase as the market increases, or we'll see something very similar to this June 11 drop where we see a huge sell-off all of a sudden. So while this only happened recently, it doesn't guarantee it has to happen again. It is still a warning signal that I respect and that I have noticed in the VIX. And that is something that I will be paying attention to as we have hit our price targets and we do see the VIX starting to creep back up. So if you look at this area where the S&P 500 had volatility enter the market, that is 100% aligned with this same exact bottom in the VIX before this spike happened. So we did have about a 3-day warning sign before the volatility came into the market. And I'm telling you, we're having that same exact look right here. And we could see the VIX spike up in a very similar way, and it's going to come unexpectedly. It's not going to be something that you can plan for. You just have to be positioned in a way that if it happens, you can capitalize on any pullbacks in the market. So another warning sign in the market is, of course, the US dollar, and we're looking at DXY here. And the same exact thing can be said about the US dollar. We see here, if we scroll over back in time, the US dollar started to show some signs of strength as it found this sort of pivot bottom and started to head higher. Now the date on this pivot is around June 10th to June 11th, and the US dollar kind of found its bottom and started bouncing until about June 26th. So from June 10th to June 26th, as the dollar started to show some strength, if we jump over back to the S&P 500 and we go to that same time frame of June 10th to June 26th, that brings us from this high to this low, which is on June 11th, and June 26th would bring us to about here. So this entire area of the market where the dollar was showing some signs of strength, we saw that the stock market really went absolutely nowhere. We had the sharp pullback, we had a bounce, and then we came right back down to that support level on the pullback. Now that tells you that the US dollar showing signs of strength like this is going to have some sort of reaction on the stock market. So if we look at the US dollar today, we do see that the dollar came down here, found some support, and it really kind of stopped tanking on this downward trend. It's sort of just going sideways, and it's continuing to find support and bounce higher. So the one thing we need to look at on the US dollar is this 5 EMA is starting to turn up, and it's getting dangerously close to crossing above the 13 EMA, which would show us that there's some bullish momentum back in the dollar, because we have not seen that on the dollar until these days back in June where we saw the stock market sort of going to a cool off period. So looking at the dollar, especially on a 1-hour chart here, we do see that the dollar is forming higher highs and higher lows, which is always going to be a bullish sign that the market could be turning around from its downtrend. So any sign of higher lows and higher highs tells us that we have to respect the fact that the dollar could be coming back, could be showing some strength, and that could directly relate to the stock market going through a correction as well. Now this chart here illustrates that point pretty well. And what you're looking at here is the red graph is of the dollar index, which is the DXY we were just looking at. And the black line is the S&P 500. And the most interesting thing to look at on here is if you look at this highlighted area over on the right side of the screen, we see that the dollar and the stock market are almost completely inverse right now. During the March crash, we saw the dollar showing some strength while the market was reaching its bottom. And right now we see the stock market reaching all-time highs as the dollar is showing some of its weakest price targets we've had in a very long time. So are we having a turnaround in the dollar, and are we going to see some strength return to the dollar, and will that cause a stock market to also have a correction? So you can look at this chart and you can pause this video and study it for yourself, but it does show that there's an inverse relationship between the dollar index and the S&P 500 right now. and that is something worth paying attention to. So we'll keep an eye out on the US dollar, and we're looking for a potential repeat of this area where the dollar showed some strength, and we could be seeing the same thing happening again. Now let's jump over and check out some of the sectors, and first up is our financials, and we see that financials had a great day today, closing up over 2.3%. And we do see that the financials are starting to show some strength after breaking out of this consolidation wedge and having this monster move. We saw financials take some time to cool off, find support, and now they're beginning to bounce. So I'm still looking for financials to come up here and test this 200 simple moving average. And we're really looking to see if the 200 simple moving average is going to act as resistance. If the 200 simple moving average acts as resistance and we see financials continue a downtrend, that is going to be a very bearish sign for the stock market, as the stock market should not be breaking to new all-time highs while financials are in a bear market. So the financials are still trading below the 200 simple moving average, and we're looking for them to come up here and test that level and see if we can break to the upside and start forming new higher highs, which we need to see the financials confirm a new higher high bull market to guarantee we're going to see the S&P 500 continue to climb higher for the rest of the year. So it's a very critical time for the financials, and we're still watching this bounce to come up here and test the 200 simple moving average at about $25 or $26 in that range. Now let's jump over to the industrials, and we see the same exact thing happen where the industrials broke out, came back down, tested support, and now they're bouncing. Now this is no surprise because we see some strength in the industrials, and we see the Dow Jones showing that the market's ready to continue higher and possibly close that upward gap. So I'm looking for the industrials to continue higher, and look at the 5 EMA trading above the 13 EMA in this bullish price action. So I'm looking for that bullish trend to continue, and as long as that continues, we can see the S&P 500 continue to go to new higher prices, especially if we see the financials start coming up and testing that 200 simple moving average and breaking to the upside. That'll show us that there's still a lot of upside left on the S&P 500. But right now, we're just watching the trends. We're seeing that they're still bullish, and the price action saying we're still expecting to see these sectors go higher. Jumping over to healthcare, we see healthcare is taking some time to cool off, and it is also flashing a warning sign as well. We do see the 5 EMA starting to find a top and sort of come down and show this negative slope. And if the 5 EMA starts to cross underneath the 13 EMA and the healthcare price action continues to close below the 5 EMA, that will tell us that healthcare possibly saw its temporary top in the market, and that healthcare is going to start taking some time to cool off. Now that's going to look like an ABC correction, and ultimately could come back down and test the 200 simple moving average here before finding support and bouncing higher. So we'll continue to watch healthcare. It's still in a bullish uptrend, but as soon as that 5 EMA crosses below the 13 EMA, all bullish signs are off the table until we see a break of that 5 EMA and we see the price action start to close higher again. But right now, healthcare is not confirming its breakout, and we're starting to see the price action break down, which is another early warning sign that this sector could be in a situation where it's going to go through a correction very soon. So as you know, we've been covering Apple on this channel because it is a market mover, and Apple's been on an absolute monster bull run since it reported earnings, and we do see these gaps below that we want to see close before ultimately heading higher. However, Apple doesn't care what we think, and it's continuing to head higher, whether it's irrational or FOMO or whatever it is. Apple continues to go higher and closes higher yet again today, well above the 5 EMA. Now I still think that this move from here to here has a lot of FOMO mixed in with it, and I think there's a lot of retail investors flocking into Apple right now, which is never the best time to enter a trade. So I would say wait for Apple to cool off. It's going to be an early indication, since it's a market mover, that we're going to see a correction in the stock market. But ultimately, we want to see Apple come down here to where it broke out, test a support, and then start heading higher, which will be a much healthier move to the upside than what it's currently doing right now. Let's take a quick look at gold, and we see that gold is still stuck in our consolidation range, where we see that gold had broken out to a new all-time high, came down, tested the all-time high as support and bounced, and it's now in a downward trending consolidation wedge pattern that we see it's just taking time to cool off, and it's trying to decide if it's going to break to the upside or break to the downside. Now remember, gold is absolutely a hedge to the US dollar, and if we do see strength returning to the US dollar, we would expect to see gold break to the downside. However, if the US dollar continues to show signs of weakness and starts back down on its downtrend, I would expect to see this break to the upside. The good news, we're doing technical analysis and we're being objective, and we're not going to guess which direction it's going to break in. We're going to simply watch and let it tell us which direction it's going to break. and then we will then have the information to make a good trade after we see the confirmation. So in gold, it's still consolidating, and we still need to wait a few more days to see whether it's going to break to the upside or the downside, and that should directly correlate with the strength or weakness in the US dollar. So bringing this all together, going back to the S&P 500, we still have a lot of bullish trends and a lot of bullish indications. However, we are starting to get some warning signals that were not there in the market before, so we have to respect those. So remember, we're going to watch the VIX, and we're going to continue to watch if the VIX is going to sneak up higher and higher while the market's climbing higher, which will tell us that there's fear and a potential big sell-off coming. Now remember, the volume has shown that a lot of the big money that bought back here where volume was very high has not got completely out of the market yet. There's a lot of big smart money in this market that have yet to sell, but they could decide to sell at any moment, and that is usually what moves the market. So as long as we see volume low and the price continuing to grind higher, there's nothing to panic about. But if we start to see a big volume sell-off, that'll tell us that there's probably something bigger going on underneath that we need to pay attention to, but we have yet to see that. So I want it to be very clear that yes, there are warning signals in this market, but that is not a reason to panic and say that the market will not go higher. We do have higher price targets here in the 350s, and we still see very bullish price action and technical indications that we're possibly going to get to those price targets. So as always, I'll be here updating you on technical analysis in these charts. So please remember to smash that like button to help me out, and subscribe to the channel to follow along on all of these updates. Thanks for watching, everybody, and as always, I will see you in the next episode.